The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Chip stocks bounce back higher, but so too do oil and treasury yields. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Raymond.
And I'm Katie Greifeld. We're kicking off the closing bell here in the U.S. And it's a really interesting board today because what's happening up here kind of disconnected from what's happening down here. You think about what's going on with the equity market. The S&P 500 higher by about 0.9% right now. Coming back to what Romaine mentioned, those chip stocks really driving gains higher. And you can see that expressed in the NASDAQ 100, now eyeing a gain of about 2% ahead of several days of very consequential earnings, headlined probably by Alphabet. But then you take a look at the bottom of the screen here. You have Brent higher once again, keeping an eye on what's going on in the Middle East. Brent higher by 2%. We are back above $91 a barrel, and that's pressuring bond yields higher, a sell-off across the curve. Currently, 10-year Treasury yields higher by 4 basis points. We are back above 460, Romaine.
Let's go back to the top of the screen and work our way down. Coming off the worst one-week loss in more than a year, chip stocks reasserting themselves today with what could be their best one-day gain in a month. If this does stick into the close, and more importantly, if this sticks beyond today, it would provide validation for the bulls who looked at last week's historic unwind and momentum and saw a meaningful rewind into the momentum stocks that can also deliver on those fundamentals. And that simple equation has chip stocks on the other side of that equal sign.
Again, it speaks to the weighting in the S&P 500. You could have large cap tech and value. I mean, very quietly, value stocks have outperformed significantly this year. Those could be enough, but we do think, you do need the chip sector to come along. The good news is that the tail that is wagging the global asset market dog, Korea, buyers emerged last night.
Right.
That's different.
And the emergence of buyers was spurred in large part by news from Taiwan Semiconductor, or news about Taiwan Semi, which fabricates chips for NVIDIA, Apple, and Alphabet. The news saying that they held discussions with clients about strategic price increases of as much as 10% for next year to cover the cost of rising manufacturing costs. Investors saw that as a sign that the AI cycle is still strong, and that helped to strengthen conviction in the next leg of the chip rally. But you go down that screen that Katie had, and you take a look at the bugaboo that the bulls have to be mindful of, the resurgence in bond yields to the highest level in about 2 months, on the back, of course, of the 10th straight day of fighting between the U.S. and Iran, which has pushed oil prices up 20+% since the start of the month.
Yeah, it's going to be interesting to see if we continue on this trajectory in the bond market. Does that make itself known in the equity market? Because at least for right now, it seems like smooth sailing, a lot of focus on the micro, on the earnings picture. But let's talk a little bit more about that chips rally, because here behind me, we've broken out the Philadelphia Semiconductor Index. That's in blue. And then you have the S&P 500 information technology sector, so the tech sector more broadly. Over the past 3 months, you can see tech at large hasn't really done all that much. We're still looking at gains, but it's really been chips. It's been those semiconductors that have been in charge. And it feels like we were at peak chip really around mid-June or so. And since then, momentum has cooled a little bit. You can see those two lines coming closer and closer together. But certainly today, you're seeing that chips trade come back. We know, though, that we're heading into a very heavy earnings calendar, which is really going to help determine what the next 3 months looks like.
Yeah, and that earnings calendar, at least to the upside, heavily favors the chip environment. Julie Beal joins us right now, portfolio manager, senior research analyst at Kayne Anderson Rudnick. And that is where we want to start here, Julie. An earnings season where expectations are high, none really higher than for the chip sector. If they deliver, and assuming they do, does that actually mean you're going to get further gains in some of those stocks?
I think you could see further gains in those stocks. There's opportunity still in front of them. They've certainly pulled back, and there's a lot of hope around those themes that they really continue to play out. But I think that the violence of the drawdown that we saw last week is a reflection that people are anxious and nervous about how long this really can continue. So there is this FOMO that's around that, but it's not necessarily driven by a lot of really strong conviction because people know they've been burned by these types of companies before. They don't necessarily have a lot of defensible protections around them. And so long-term contracts are good, but I think people are still a little bit suspicious of this space.
Does that suspicion, though, maybe potentially actually benefit some of the software companies and hyperscalers? I think about earnings expectations. The expectation is semiconductors as a group in the S&P, 133% growth in EPS. But when you look specifically at the software and services sector, just about a measly 16%, which in any other year, I think we would be applauding. But does that mean that maybe the bar for those companies is low enough where it can actually surprise to the upside?
I totally agree with that. I think that's true. I think a lot of these businesses, many of them, investors really do want to own. They did want to own them for a really long time. They had high returns on equity, recurring revenue. There was a lot to like about software. It was really part of any balanced diet. And I think now that we have this existential cloud hanging over, it's hard to get really enthusiastic. But I also think that that means that the bar is really low for these companies. And I think if they can put together good guidance for the forward year and talk about how they're integrating AI into their products, they should, I think, be in a better position because just the expectations are not quite so high there.
And I do want to, think about this conversation in the context of what's going on in the rest of the world, because, as I mentioned and as we've been mentioning, you think about what's going on in the equity market. It feels like it's sort of marching to a different drumbeat than what you're seeing, particularly in energy, but also in the likes of the bond market right now, which is responding to energy, but also the situation on the ground in the U.S. economy, thinking about where this Federal Reserve is going to go. And I wonder if you do see a disconnect here between the different asset classes and whether you think that can be sustained, if so.
Yeah, I think, we had moved into this period where there was so much correlation between bonds and equities. It's like hard to remember a time where that wasn't the case, but that hasn't, typically actually been the case. So, I think what we can see right now is that there is this divergence, but part of what's pushing yields up, I think, is, the strength of the economy just makes it harder for the Fed to really be able to cut rates in any meaningful way. I don't know if there's, a rate increase in there, but I think that is the fear that a lot of bond investors have. But separately for that does mean that if, we have a stronger economy, that should be good for equities overall, and certainly for small caps who can be even more economically sensitive and more domestically focused anyway.
That's really interesting because, in thinking about values outperformance and thinking about small caps outperformance, particularly for the latter, a lot of bullish cases are predicated on the idea that rates are going to stay stable or come down from here. But it sounds like what you're saying is that, if we do see rates stay at these elevated levels, maybe move higher, if it's because of economically sound reasons, it doesn't necessarily have to bedevil that rally.
I think that's right. I think so. I think that it can be more meaningful that the underlying macro fundamentals are strong enough to offset any kind of increase or flatness of interest rates for many of these small cap companies. And the reason why we care about interest rates so much with small cap is just because most of them are financing at the bank and on variable interest rates. So a lot of the excitement around small caps initially started because people were thinking, look, if interest rates are lower, that's probably not in earnings estimates, and so these things can trade better. And I think that's true. But at the end of the day, what actually really drives earnings and the stock performance longer term is less about a one-time change in interest rates, and it's much more about the underlying fundamentals. And to have a healthy economy really is going to be more meaningful for companies than having to pay a little bit more interest expense, especially if they tend to, if you focus on quality and have companies that don't have a lot of debt.
All right, Julie. Always a pleasure. Julie Beal over at Kayne, Anderson, Rudnick, kicking us off to the close here on this Tuesday afternoon. When we come back, a closer look at the ADRs of Novartis having their best intraday move in 3 years on the back of an earnings report that showed a return to quarterly revenue growth. We're going to catch up with the CEO after the break and ask him whether that growth can continue. This is The Close on Bloomberg.
Vanguard out with its latest AI outlook, saying that the technology could help drive one of the strongest periods of U.S. economic growth in years. The firm expecting roughly 3% U.S. GDP growth in 2027, which is well above consensus. Joining us live in studio is Rachel Aguirre. She is head of product and portfolio strategy over at Vanguard. Rachel, great to have you on set with us. I want to break down that 3% number a little bit because, within that figure, which sectors, which industries are poised to really help drive the overall picture?
Well, it's really interesting, and what you said is exactly right. We are incredibly optimistic. We are well above consensus when it comes to 2027 U.S. GDP growth forecast at 3%. Why is that? It's because we believe AI, more than just bringing incremental gains, is ultimately going to be transformative to the U.S. economy. Now, the ultimate question, though, is where do those opportunities lie? What sectors are really going to be driving that growth? We think it's value. We think it's actually ultimately going to be the users of AI, those companies that can benefit from productivity gains, from new services, new products, innovation. That's where you're really going to see the AI boom ultimately accrue to. And we see that in past kind of general purpose technology breakthroughs. It's rarely, if ever, the builders or the developers of the technology that ultimately capture, the greatest long-term value. It's the users.
That's really interesting because for the past several years, you take a look at where investors' attention has been. It has been the builders, the picks and shovels. How many times have we said that? And I guess the question is, when does that leadership baton sort of get passed off? When do we enter that next phase of that AI investment cycle from the market standpoint?
Sure. Well, we're still in, an acceleration of the pace of AI capex. That is continuing. We think we're still, call it another 1 to 2 years out, before we get to the peak spending from that perspective. But you're going to begin to see the users of AI start to accrue that benefit, if you will. So what are things that we're looking at? We're looking at profit margins in the value sectors and portions of the market. We're looking at earnings growth in those portions of the market as well. We're in an interesting moment right now because markets are being driven not only by fear or not only by greed. It's both at the same time.
Well, on finding that value, though, how do you do that? Do you sort of try to get ahead of that, or do you wait for the companies to come out and bang the drum and say, look, here are our productivity improvements, here are our margin improvements, or do you play this just as sort of a profitability margin type of factor play?
Look, from Vanguard's perspective, we actually think now is the time for investors to take a step back. I talk about how markets are experiencing a lot of whiplash. Like on the one hand, we see investors pursuing opportunities. We saw record-breaking flows into U.S. listed ETFs. Before we hit summer, we surpassed $1 trillion. That's massive. That is record-breaking. On the other hand, we speak to advisors all the time at Vanguard. They're very concerned. There is a lot of uncertainty. It just take your pick day to day. It's tariffs, it's rate uncertainties, potential hikes, persistent inflation. And so, we think investors need to take a step back. Don't miss the bigger picture here.
Well, with regards to that bigger picture, though, I understand the idea of maybe taking a step back, but you also understand that sort of the FOMO, the fear of missing out. And when you look at the spectacular gains that have largely come from chips and a few others, how do you sort of navigate that from an advice perspective?
Sure, absolutely. Yeah. So this is really about how do you capture the long-term opportunities within AI and understand that there will likely be a bumpy road along the way. That's why we think there's such elegance and such beauty in the value story, because it's where you're ultimately going to get the long-term opportunities from AI. It's the users, not the builders or developers. But it's also that short-term insurance along the way as we experience what will likely be a bumpy ride.
All right, Rachel, great to have you here on the program. Rachel Aguirre, head of product and portfolio strategy over at Vanguard. A closer look at the value side of the AI trade. When we come back, we are going to talk about Novartis beating estimates on the top and bottom line. Some questions, though, about the long term. We're going to talk to the CEO, Vas Narasimhan, when we come back after the break, right here on Bloomberg. Shares of Novartis higher on the day. This after the Swiss drug maker beat estimates for both sales and earnings in the second quarter. The drug maker's new cancer medicines offsetting declining sales for its former blockbuster Entresto. We sat down with the CEO, Vas Narasimhan, earlier today to break down the quarter and the company's roadmap for the years ahead.
We really feel like this year has been a tale of two sides. On the first half of the year, we needed to navigate these expiries, largest expiries in our history. And then we get into the second half to a period of now growth that we expect to sustain over the coming years to deliver the 5 to 6% growth that we've outlined. Our second half is going to be about investing in the pipeline and investing in the launches that will fuel that growth. So we saw we really delivered at the upper end of our guidance in the first half, but we still think it's prudent not to raise and to actually maintain our investment levels, ensure that we're setting up well for this next phase of growth going forward. And of course, we'll reevaluate in quarter three based on how the numbers flow.
So investors are obviously looking at the balance between the loss of patent protection on 2 or 3 of your drugs that had been big winners for you, and of course a new pipeline of products with that patent protection. When we start to talk about some of those names like Kisqali and others, can they make up for the deficit off of the loss of that patent protection?
Yeah, we feel really confident. I mean, when you look at already growth in quarter two, I think that's showing that our big medicines, Kesimpta and Kisqali with a $10 billion peak sales, Kesimpta with a $6 billion plus peak sales, are firing on all cylinders and can carry us through the end of the decade. But what's really exciting is the rest of our cancer portfolio, drugs like Scemblix and Pluvicto performing extremely well. Our cardiovascular medicine, Leqvio, had an outstanding quarter, and that's a drug we've guided to $4 billion plus peak sales. And then we have a few new launches that have just kicked off, drugs like Rudnick. Taken together, we think that gives us more than enough to actually grow in that 5 to 6% range through the end of the decade. And I think what's exciting is with all of the phase 3 readouts, 6 plus phase 3 readouts that we have over the back half of the year, if a few of those hit, we have the opportunity to further upgrade that midterm guidance.
With regards to some of these new products and the pricing on them, with the backdrop, of course, of some of the U.S. regulatory decisions, or we should say pressure coming from the White House to keep those costs in check, have you found a balance between what you think you are going to be able to price on a competitive basis relative to maybe what pressures come from the government?
You know, when we look at our mid and long-term guidance, we factored in now the MFN agreements that we've signed with the U.S. government. That does mean we have to think differently about how we price medicines, particularly in the 8 target countries of that agreement. And so we factored that in. I think what remains to be seen how those countries respond, because I think the one expectation, understandably, is that those countries start to raise their prices to properly value innovation on a GDP-adjusted basis. We see some positive signs. Countries like Japan are making the right moves and trying to increase their prices, which allows us then to adjust our U.S. pricing. But other countries go the wrong way. I mean, Germany recently passed a law that really was a setback in reimbursement and valuation of medicines in Europe. And so that's a cause for concern. So I do think over the next 3 to 4 years, it's going to be bumpy as we start to work through how we implement pricing in the context of most favored nations.
Yeah, and I know that, you had some comments about Germany and sort of the approach that they've taken on your earnings call a little bit earlier. And I wonder, what you think the net effect of this will be as you have these different drug pricing conversations around the world, not just in the U.S., but in Europe, in Germany as well, because one of the fears out there is that, you think about Europeans potentially seeing reduced access to new drugs. And I wonder, in your view, whether or not that's something that you think could actually play out.
We're already in a situation where only 60% of new medicines are launched in a timely manner in Europe today. And so I see that going down. I think there'll be even a lower percentage of innovative medicines that are launched, or they might only be launched in the private market, not in the government reimbursed market, as these policies continue to get rolled out and this environment doesn't get approved. I think what will ultimately happen is similar to what we saw in Japan. Eventually it gets to a point where the public will no longer accept the fact that the latest medicines are not coming to patients in that country, and then we'll see a correction. But I think that still is going to have to happen. This has to be something where patients and patient groups and physicians demand governments to actually enable these latest innovations to become available. I'm hoping that will happen, but I think that's going to take time. And unfortunately, in the medium term, we're going to have a lot of bumpy years in terms of where we launch products in Europe.
And you also mentioned, some of the acquisitions that Novartis has made over the past year. You think about Avidity, for example. I know you said on the media call that you're going to continue that strategy of, smaller deals here, smaller biotech companies, but you're remaining open to larger acquisitions. And I wonder, what are the necessary ingredients that you would need to see when evaluating one of those potential bigger ticket deals?
Yeah, when you look at our history, we've always looked at those bigger deals as bringing hopefully a technology platform and some assets that we think are late stage in our core therapeutic area. So you look at Avidity, neuromuscular disease, it combines RNA therapeutics in an area that we're highly interested in. It gives us a new technology platform to develop a whole new range of RNA therapeutics. The medicines company, that was about a $9 billion acquisition, that brought in, again, RNA therapeutics for cardiovascular disease, another core area. We acquired 2 companies for radioligand therapy for $4.4 and $2.1 billion. So I think whenever we find a profile that gives us new capabilities as well as late stage or mid stage pipeline assets, that's when we get excited about larger deals. And we're not looking just to buy sales. We really want to bring in capabilities or strengthen one of our core therapeutic areas.
And our thanks again to Vas Narasimhan. He is the CEO of Novartis, and certainly you saw shares rise on the back of that beat. But they're in a really interesting position, Novartis, when you think about the fact that they're facing one of the steepest patent cliffs when it comes to pharma. But at the same time, they also have one of the busiest pipelines over the next 6 months.
Yeah, and it's a pretty strong pipeline. The question is, does it scale up to actually make up for that deficit that they are having from that loss of exclusivity on the other drugs? But you look at the cancer pipeline, and he talked a lot about the new prostate cancer treatment as well as the new breast cancer treatment, and the idea that, at least in his view, he thinks that can fill the hole.
Yeah, absolutely. And you think about those readouts, what they could mean for the stock. We discussed this, of course, with Voss. The fact that you take a look at what Wall Street is sort of factoring in for their post-2030 growth, it's not much, but maybe, once they start to actually get these readouts, they'll upgrade guidance, and have to imagine that would be a catalyst for the shares. So an interesting update there on Novartis.
Yep.
And coming up, we're going to pivot a little bit to talk about Amazon's e-commerce portal for businesses. It hit $60 billion in sales. We're going to discuss what's driving that growth and what's going to drive growth ahead with Daniel Silverfield. He is Director and Head of Value and Selection over at Amazon Business. That conversation coming up next. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Raymond.
And I'm Katie Greifeld, keeping an eye on these markets, but also keeping an eye on Amazon. It's interesting. You think about how people shop. It's in the muscle memory to just log onto Amazon and click the button. And increasingly, it's also becoming the muscle memory of corporations.
I was going to say, for most regular people and households, that's sort of the reflex. But apparently we're learning that's also now the reflex for a lot of companies as well.
Yeah, absolutely. Specifically, Amazon's business sales unit recently on track to sell $60 billion of merchandise over the course of a full year. And that's up 71% since 2023, which is pretty amazing for a business that's been around since 2012. So let's talk about it with Daniel Silverfield. He is Director and Head of Value and Selection over at Amazon Business, joining us in studio. Daniel, great to see you.
Thanks so much for having me.
So you think about, your business sales push over at Amazon. As I said, it started in 2012. It was first known as Amazon Supply, rebooted as Amazon Business 3 years later. But just since 2023 or so, you've seen huge growth as a percentage when it comes to this unit. So what is going right? What changed in 2023?
Thanks for having me. So $60 billion in annualized gross sales, 11 million customers worldwide for Amazon Business. And the reason we really even exist today is because we saw businesses shopping on Amazon.com. And when we reached out to them, universally they had the same message. Business buying is too complex. So we built Amazon Business from the ground up to simplify the procurement journey across wide selection, great prices, a B2B tailored delivery experience, and we've been earning trust with customers ever since, hitting $60 billion in top line.
So perhaps just a flywheel sort of there. So when you describe that experience that, you noticed businesses were shopping on Amazon anyway, why not sort of formalize that process? what kind of business are we talking about? Because, I could see a smaller company do that, but how do you sort of expand into the larger corporations as well?
We've got businesses of all shapes and sizes, and what we hear from them is the same thing: simplicity, value. And the way that we deliver that is, you mentioned the flywheel, across selection, across pricing, across delivery experience, because they're trying to do more with less. That's a big trend in the procurement industry right now. How do they save money? Can they buy in bulk? We saved customers $1 billion last year when they made bulk purchases on Amazon Business, business-specific discounts. And Profitero, an independent agency, says that we're 14% cheaper than other online retailers.
Well, two questions on that. First, just from Amazon's perspective, is this a business that provides the margins that makes it worth it? And I mean that relative to maybe what you would see from a consumer transactions. I mean, B2B, I always thought had somewhat slimmer margins.
We see extreme value and providing value for customers. And you're seeing the same cost to serve for Amazon Business as you do for our consumer side. But if you think about how we consolidate packages, we deliver on pallets, a lot of times you're seeing that really nice improvement in cost to serve to our customers.
Well, on the cost to serve to the customers, how much does technology play into that? And we were kind of talking about kind of the reflex to, that most consumers and households have to reorder things on Amazon. Is this going to be more of an automated process? And I mean that from the perspective of so that the procurement managers don't have to spend an inordinate amount of time going line by line through the items they need and when they need them.
You're spot on.
Yeah.
So generative AI is a massive unlock for business buying and for procurement officers everywhere. And the reason is kind of twofold. One, it's a proactive way to understand how you can spend better. So we have an Amazon Business Assistant. It's an agent. You can go to it while you're making a purchasing decision and say, what's the best item for copy paper that gives me a mix of quality and value? So you get a real-time suggestion. And then the other is that you can have generative AI comb through your spend history and give you an analysis of where you could combine purchases. Instead of buying something once a week, every week for 52 weeks, batch it, buy it for a month, send it out to your different headquarters, and you're going to save money.
And when it comes to, some of the larger customers that you've been courting, I mean, Bloomberg News has reported that includes folks such as the University of California at San Diego, NASDAQ, Amazon's own operations. I hear what you're saying when it comes to AI and sort of tailoring that experience, but how tailored are some of the deals, some of the quotes that you're giving those larger corporations, those larger organizations, and sort of enticing them to come to you?
One of the great things about Amazon is our negotiating power. So we can negotiate on behalf of businesses of all shapes and sizes, from the mom and pop laundromat down the street all the way up to 97 of those Fortune 100 customers. And when we negotiate on their behalf, we're also bringing in millions of sellers who are vying for their business too. And these sellers provide over 50% of our GMS, our sales annually. And they have incredible diversification of selection, which helps us with supply chain resiliency, which helps our customers consolidate their spend. So instead of going to, say, 10 different institutions to buy, they can come to one place. They can have all their data and purchasing history in one place, and it saves them time. It's much more efficient for them.
And I do want to go back to that stat I mentioned, that $60 billion figure. Again, that's up 71% from 2023. I mean, what are you modeling internally when it comes to a realistic rate of growth? I mean, do you have any targets, as to how big you would like that $60 billion to grow over the coming years?
Here's what I can share. The B2B market space is enormous, multi-trillion, and we're just scratching the surface. And for us internally, our ethos is that if we can provide extreme simplicity, great value for our customers, again, across that flywheel of selection, pricing, delivery experience, then we're going to be in a really nice spot for these customers and for growth over the next 10 years.
Who are you competing with directly?
We don't look at competitors that closely. We look at how do we provide value to our customers. And there are competitors across tens, hundred different verticals.
But you can't look at that without understanding what those potential customers are paying or what the value proposition they would have with someone other than Amazon, right?
Well, if we negotiate and use Amazon's negotiating power to make sure that we are providing the best possible prices for our customers, we find that they keep coming back to us and we earn trust with them. We had 1.8 million new customers join us just in the first half of this year. We see incredible growth from both new and existing customers. And again, they trust us, They're coming to visit us because we're providing all these great flywheel inputs, and we're using generative AI to give them insights.
All right, Dan, great to have you here. Daniel Silverfield, Director and Head of Value and Selection over at Amazon Business, of course, the B2B business that they've been building out now for the last few years. When we come back, we're going to take a look at shares of GM, and we're going to take a look, more importantly, at that 2026 outlook. Investors were very pleased as to what they had to hear. We're going to break it down when we come back next as part of our Stock of the Hour, right here on The Close, right here on Bloomberg.
While we are seeing some inflation, the opportunities and the tailwinds we have elsewhere in the business have been more than enough to overcome it. And that's why we've been able to get back into our 8 to 10% margin range in North America, despite $3 billion of tariff headwinds and other inflationary pressures.
Paul Jacobson, the CFO of GM, speaking earlier today on the heels of the automaker's beat and raise earnings report, a beat and raise earnings report that has the shares up by the most in about 2 months. Joining us right now to talk a little bit more as to exactly why. Joining us right now is David Welch, Detroit Bureau Chief. All right, David, let's get to the heart of the matter here. I mean, we did hear from the CFO earlier. Is this kind of a one-off type of quarter, or are we going to start to see a more of a structural shift here in the direction of this company?
I think that's what the market's trying to figure out, which is why the share price reaction was pretty muted after raising their guidance. You know, look, on one hand, I think you'll kind of see this lower tariff impact compared to a year ago. That will carry forward. Some of the other stuff, can they keep pricing up, particularly on the gas-guzzling vehicles that make them so much money, with gas prices being high and this war looking like it's going to have some staying power here? That's a big open question. Will consumers keep paying this kind of money for $52,000 average price for a General Motors vehicle? That's still up in the air. And can they keep these warranty costs down? We've seen quality fluctuate and cost fluctuate with all these companies.
Well, that's what I'm curious of. I mean, this definitely seems like one of those quarters where it's a little bit more about the financials, meaning financial management, particularly on pricing. And as you mentioned, of course, keeping certain costs down with regards to warranties and tariffs. Is there a volume story here in terms of cars sold going forward?
No, in fact, in the second quarter, their sales were down. What they did at retail, what they did do more of is they built more vehicles because inventories got thin in the first half of the year. Car companies book their revenue when they build the vehicle, not when they sell it to the consumer. So that helped them there. They're also building out because they've got a new pickup truck coming to market. They're building there. They did say, Mary Barra said that she sees this improved financial performance as being sustainable into 2027. But they're going to have to prove that. And I think the market's telling us that by, kind of buying into it just a little bit. They've got to keep the prices up. They've got to keep the warranty costs down. And is there volume growth? I don't really see it. I think everybody in the industry is trying to play for better pricing and margins as opposed to going out and getting more volume. And the consumers are in a holding pattern right now because of interest rates, inflation, and fuel prices.
Mm-hmm. And, we're talking about General Motors. You can see shares higher by about 5% right now. You're also seeing shares of Ford rise a little bit on the day as well, higher by about 2%. And David, I wonder if there's any takeaways from what we heard from GM, particularly when it comes to that pricing strategy that they're employing for those larger trucks that you can apply to a Ford, for example, which reports in the coming days.
Well, yeah, I think you probably can, and that's why their shares are up a bit too. Look, if you're buying large pickup trucks and large SUVs from GM, you're probably a potential customer for Ford as well. It's a similar market, similar kind of consumer. Those people have money, so they're less affected by gas prices and that sort of thing. And I think Ford's playing the same game where they're trying to sustain margins too, to a certain degree. So you could see some similar reaction here. Then the other part on the cost side of it that helped GM, does Ford get the same benefit to their earnings from tariff relief and also quality issues? Or they've had a real tough time with that for a while. So we'll see if they can kind of flow through to the bottom line some of these same things that help GM's profits.
And we have just about a minute left with you. We're also awaiting Tesla earnings tomorrow. We know that their deliveries were pretty good, but when it comes to EVs, the hopes was that if you do have higher gasoline prices, that maybe you see more people pulling back on gas engines going into EVs. It sounds like GM is saying that that narrative doesn't really hold water.
I don't think it really does for anybody, to be honest with you. It might a bit for Tesla, but so far that has played into the hands of Toyota and Hyundai because they've got hybrid electric vehicles. It really hasn't helped pure electric sales to a really great degree.
All right, David, really appreciate the context as we watch GM shares rise. That is our Bloomberg Detroit Bureau Chief, David Welsh. Now, coming up, it's the closing bells. We're just about 15 minutes away. We're going to take you through all the action with Matt Orton. He is head of advisory solutions and market strategy over at Raymond James. He joins us next. This is The Close on Bloomberg.
10 minutes until we get to those closing bells. I'm Romaine Bostic.
And I'm Katie Greifeld. We are rallying into the finish on this Tuesday. The S&P 500 higher, helped in a big way by what's going on in the tech sector. What's going on specifically when it comes to semiconductors, to those chip names, Romaine? They've really been sort of the epicenter of volatility for the equity markets over the past few weeks, and at least for today, it's volatility to the upside. Yeah,
and it's kind of interesting. Yeah, it's good you point that out because it is sort of this yin-yang. You had more of a sustained loss last week, but this is kind of the cycle we've been in for the past few months now, where anytime you get any sort of meaningful drop in prices here, that volatility to the downside, within a couple of days, you get the reverse.
Yeah, it's going to be really interesting as we get into the heart of earnings season, as we get some of these big tech names to report, particularly their CapEx numbers, whether that sort of breaks the pattern of volatility and gives us some clarity on the direction forward.
Absolutely, and investors think they got maybe a little bit of a hint as to what's to come on the back of that Nikkei report that TSMC is indeed going to start raising prices by about 10%, a strategic move heading into 2027. To talk a little bit more about the chip trade as well as the broader earnings season is Matt Orton, head of advisory solutions and market strategy at Raymond James. And he joins us here in New York. Great to see you.
It's great to join you, Romaine.
Let's talk about the chip trade. And we talk about the gains that have already sort of been booked on this. Gains that I think most people would say have been justified by revenue growth, justified by margins and EPS. We're heading now into another earnings cycle where not only will we want to hear what happened over the last 3 months, but whether those CEOs and CFOs are going to be as bullish about the months going forward. Are you optimistic?
I am optimistic, and I fully agree. I think what investors want to hear is that not only are the hyperscalers continuing to make investments and increase their CapEx numbers, we're going to get the first look at that tomorrow after the bell with Alphabet, and then it's really, are we still seeing the revenue and earnings acceleration taking place at a lot of these semiconductor companies that you would need to justify a lot of their share price moves? So far, I would say the parabolic moves are justified by parabolic increases in earnings growth, so we have to see that sustained, and I think we're going to see that given what we've already heard from ASML, what we've heard from TSMC during earnings, and what they've just reaffirmed with their pricing power.
But does this become one of those situations where what benefits the chip makers ends up hurting some of the other companies? Because every time I hear about price increases, that's great if you're the one selling and making those price increases. But if you're the taker of that on the other end, or is that the wrong way to look at it, particularly when it comes to the larger customers?
I think the larger customers are a little bit price insensitive at this point because they still have free cash flow that they can put into this. The capital markets are open to them in order to continue to finance what they have to do to build. And when you look at the backlogs that we heard last quarter and through a lot of channel checks that we've done over the past few months, what you've heard from a lot of CEOs of these hyperscalers is that they have $2 trillion backlogs for their cloud businesses. So spending $1 trillion to get $2 trillion in real tangible revenues that are legally binding in most cases, that seems like money well spent.
So it sounds like you remain confident in that story at a time when there's a lot of questions being raised. We had a great chart that we were showing yesterday that you look at 12-month forward cash flow estimates for hyperscalers versus semiconductors, and it's a flip-flop in favor of the semiconductors. And when it comes to the capital markets, I mean, you think about some of the receptions in the primary debt markets to some of these big deals. They're starting to cool a little bit. We're talking about oversubscriptions, but maybe less than we would have seen in the previous 6 months or a year ago period. But it sounds like what you're saying is that you still remain pretty confident in that story.
I remain confident, Katie, but it's all about execution, right? So earnings season is a great time to make sure that these companies are on track. Those who are spending, are they monetizing in their cloud businesses? Are we seeing the RPO, their performance obligations, continuing to grow, which means there's still a backlog for where they're investing all of that free cash flow? And I think the market pushing back a little bit on the massive amount of issuance that we've seen, both from debt, equity, I think that's healthy just to say, like, you have to show some sort of return or a path towards that. And the more successful companies, I think, will, and that's what I expect to see tomorrow, starting with Alphabet.
And Matt, I'd love to get your perspective on this broadening out trade because, you know, we've been mentioning it. You think about what we're seeing in value, that's outperforming, small caps outperforming, and it's kind of curious and unintuitive given how much time we spend talking about big tech and what's going on with the AI trade. But when it comes to that broadening out, do you think that there's still room to run when it comes to those areas of the market?
I think there's room to run, Katie, but I think you have to be specific about where you're looking for investment. So the earnings breadth story has been here for a while. We've had earnings breadth across S&P 500 sectors for well over a year at this point. And what's encouraging is that we're seeing other sectors, financials primarily, who have already been reporting, we're seeing that earnings momentum continue to the upside, and that's finally being rewarded with respect to share prices. So I think there's more room to run in financials. Other sectors have to deliver that growth. But then the question is, valuations aren't necessarily attractive across all of those spaces. So
I do want to get your thoughts on what's been happening in the pharmaceutical space. I mean, basically, at least when you look at the main indexes, whether it's NASDAQ Biotech, S&P Pharmaceuticals, all keeping pace with the broader market so far this year. And Bloomberg just had a great story about the outperformance of biotech and drug IPOs this year relative to all of these tech IPOs that we keep talking about, which have underperformed here. Is that a long-term story?
I think it is.
Yeah.
So, Romain, we were talking beforehand that, we've been finding opportunities in biotech really for this entire year. I think that had been an underrepresented story up until the past couple of months. You've seen biotech outperform, but I think there's sustainability there because large pharmaceutical companies have patent cliffs. You're seeing and hearing that during their earnings reports. Yeah. What do? They buy smaller cap biotech companies, and you're seeing that reflected in the investment banking numbers that have already been reported so far. So I think there's a lot more room to go on the biotech side. I would use downside opportunistically. It's never a trade to chase, but if rates, which have gone to 4.6 in a hurry at the 10-year yield, start to come down a little bit, I think that opens up the path for biotech to really start to outperform again, as investors maybe are more willing to take risk again.
All right, Matt, great stuff. Great to have you here in studio. Matt Orton, Head of Advisory Solutions and Market Strategy at Raymond James, as you count you down to those closing bells. And I do want to just draw attention to that article. It was a great article because it kind of struck me by surprise. IPOs of biotech and pharma companies, weighted average return so far this year, 55%, compared with everything else. That's down 4.4%.
I have great news for you and the audience. We're going to discuss that article at length at like 4:15. So stay tuned because it will be a robust conversation.
It will be a robust conversation. The rally in the markets, at least robust when you look at sort of the aggregate number here. So this is not a broad-based rally.
Yeah, not at all today. But again, it feels like a sort of wait and see moment. We know we have the big names coming up in the days ahead. We know we're getting Alphabet, Intel, the list goes on. And, we'll have to see what sort of catalyst that provides, what new narrative emerges. About 220 stocks in the S&P 500 are in the green, led largely by SanDisk, Western Digital, and Micron. To the downside, a lot of those materials and industrial names dragging the index lower. A full breakdown starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romain Bostic alongside Katie Greifeld taking you through to that closing bell. It's a global simulcast. Carol Massar, Tim Stenovic, they join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. With all of the major U.S. indices solidly in the green, the S&P up 1%, the NASDAQ indices, Carol Massar, up about 2%.
Yeah, thank you, semiconductors. They go up, they go down, they go up, they go down. They go up today, more than 5%. Every name, 30 names in the Philadelphia Semiconductor Index, 30 of them, they are all higher in today's session.
Which one's your favorite?
Ooh, that's a good one. I like TSM.
Love them all.
I like, me, I used to talk about the
She loves all her stocks.
names in
equally.
China, and, I do.
All right.
I don't have a favorite.
Also higher.
But I do like TSMC.
Also higher today is oil. Brent up $91 a barrel, up another $2.20. WTI up another $1.68, $85 roughly for WTI futures, Katie.
You wouldn't know it from looking at the equity market.
I know.
We've been talking about that on the close, this sort of disconnect that we're seeing. You do see that a little bit when you take a look at the bond market. 10-year yields back above 460. It's going to be interesting to see how long we can sort of see that discordance among these asset classes.
Yeah, and it gets to this idea of what type of dispersion we could potentially see in this earnings season because of all of the factors sort of at play, including some of the geopolitical factors that have driven a lot of concerns about inflation and whether that inflation persists. A relatively light earnings afternoon here. We are expecting a couple out of insurance company Chubb as well as credit card company Capital One. Meanwhile, the closing bells in New York has green across the screen for the most part, with the Dow Jones Industrial Average adding almost 400 points on the day, or about 0.7%. The S&P 500 up about 66 points, or 0.9%. The Nasdaq Composite up 1.3%. The Nasdaq 100 up 1.9%, and the Russell 2000, the small caps, Carol Masser, adding about 45 points, or 1.5%.
All right, Romaine Bostic, I go back to the S&P 500. 230 names gaining on this Tuesday. Katie got 271 to the downside and 2 unchanged.
A lot of breath when it comes to the circle here, which measures the sectors. 9 sectors finishing in positive territory, led by information technology, higher by 2.4%. That is the big green slice on your screen there. Energy also having a great day, as we were talking about. Healthcare too, rising by about 0.6%. Meanwhile, take a look at what didn't perform today. Relatively small sectors within the weighting of the index. Consumer staples down by about 1%. Communication services not too far behind, Carol.
All right, so let's go to some individual gainers. Let's talk about SpaceX. At its high, up more than 8% intraday today, but finishing with about a 3% gain here at the close on this Tuesday. Macquarie coming out saying, hey, the stock's pullback offers investors a compelling entry point to buy at a discount. Stock down almost 40% from its high on June 16th. That was after 3 days of trading from its IPO. Meantime, I just want to throw this story in too. SpaceX has set the stage for one of the largest share unlocks in capital market history, with as much as $116 billion worth of stock becoming eligible for sale for the first time next month. That's on August 6th. That's 2 days after the company does its first quarterly earnings. So we'll be watching. But nonetheless, investors buying in today's session today. Utz Brands, let's go there. Interesting name here today. This one up 88%, almost 89%. Company agreed to be taken private in a $2.9 billion deal with Intersnack Group, giving Intersnack its first foothold in the U.S. market, acquiring all of Utz's Class 8 shares for $14.25 each. Stock closed at just a little bit over $14 a share today. Deal expected to close in the fourth quarter and will be financed by cash from Intersnack as well as a term loan and asset-based lending facilities.
What's your favorite Utz product?
Potato chips?
Yeah.
You mean versus pretzels?
Yeah. They have so many different brands, including Tim's Cascade Snacks.
Which one is your favorite?
I like Tim's.
Shocker.
Simple.
Interesting.
Simple. All right, General Motors, I just want to throw that into the mix, if I may. GM up almost 5% here at the close. This is after the company raised its full-year profit forecast by another $500 million after beating second quarter earnings estimates, powered by stronger margins on its largest vehicles and lower tariff costs. They did lower, though, their expected net income by at least $1.5 billion to a range of $9.9 billion to $11.4 due to electric vehicle-related charges, but they don't expect further large write-downs on EVs and batteries because they've all kind of written down a lot already.
All right, those are some gainers. Let's talk about some decliners today, including the worst performer in the S&P 500, Danaher Corp, down 11% today. This was its worst day going back to September of 1991, and at one point, it was the worst day since October 19th, 1987, which
where were you
we
in
all know.
Yeah.
I was in the tri-state area.
Were you?
Yeah, I was. That
Were
was
you in college?
That was Black Monday. I was not in college then. The company gave core revenue growth out guidance for the third quarter that fell short of the average analyst estimates. We also actually saw other life sciences stock take a hit as a result of this report. Also, Charles Schwab fell today, despite the fact that earnings topped estimates. Retail investors continue to jump in and out of the market. The volatility sparked by geopolitical uncertainty was a boon for the company. Shares fell by 2.5%. They were up for a portion of the day, then fell a little earlier this afternoon. We spoke to Rick Wurster, the president and CEO of Charles Schwab, a little earlier on our program. He said that the trading platform, saw 3.5 times more volume on down days in the market, meaning the clients are buying the dip.
Yeah.
He said geopolitical risk in the markets, they're more actively trading. He sees more frequent trading, but the size of the trades are often smaller.
Interesting.
So, yeah.
I listened to that interview.
Sorry?
I listened to that interview.
Oh, thank you for tuning in.
I did, yeah.
And you loved it, right?
Hold on.
You're like,
and
you were taking notes. Oh, that's how you do a good interview. Is that what happened?
Yeah. I mean, you let him off the hook on a couple of questions there.
Okay.
Carol, but other than that, yeah, it was fine.
Yeah, thank you for your feedback. I'll get the manager for you.
Where were you yesterday, by the way?
Me? I was around.
Yeah, I saw you around, but you didn't stop by.
You seem a year wiser, Roman, than you did yesterday.
Was it your birthday yesterday?
No.
Oh. He's
No.
a year.
It wasn't?
No, I'm like Benjamin Button. I just get younger.
Katie, is he lying?
What else you got, Tim?
Katie, is he lying?
No comment. I don't want to blow up his spot.
Oh, you anchor teams.
Katie,
you stick together.
You only got a couple more days of
I
this,
know.
so.
Do you care about yields at all?
I care a little bit about yields.
Well, they're
what
up.
happened?
Short-term yields up for a fourth straight session. In fact, now up about 13 basis points on the 2-year yield over that stretch here, as a lot of people now start to price back in some of the inflationary pressures and I guess the potential maybe that the Fed could raise rates. Obviously, there's a pretty direct correlation here between that rise in yields, the sell-off in the Treasury market, and what we're seeing with regards to the rebound, Carol, in oil prices.
All right, quickly, Capital One Financial just crossing the Bloomberg terminal. Let's go to the numbers. Second quarter net revenue, folks, up 27% year over year, 15.9 billion. Net charge-offs, 3.6 billion. That's exactly what the street was forecasting. Second quarter adjusted EPS, $5.81. versus $5.48 year over year. And we're looking at the stock. Maybe we can bring it up here. Just real quickly, I'm going to bring it up here. I'm looking for it. It is up 1.1%.
I also just want to bring in Supermicro here. It looks like they're just providing a bit of a business update, crossing the wire right now on their revenue for the fourth quarter, their fiscal fourth quarter. The company says it will be at the low end of their previous range of $11 to $12.5 billion. Basically, the low end of guidance gross margin will now be at 15 to 17%. That's versus previous guidance of 8.2 to 8.4%. So basically, revenue at the low end of the guidance for gross margin well above what they previously guided. And the company now saying that its backlog for the fourth quarter hitting a record with new orders topping 60 billion. Of course, this is effectively a builder of data centers and effectively renting out the servers for other folks. As we know, of course, ran into some issues in the past with regard to some accounting issues and whether or not it can get itself back on track. You see the knee-jerk reaction in the after-hours trade up about 6%.
Yeah, it's been a volatile stock, to say the least, in recent years. In 2023, up about 250%. It did rise today along with all the chip stocks. It was up today about 7%, and it's adding to that in the after-hours, up about 6% in the after-hours.
It's interesting to see this update coming from Supermicro. I mean, they were scheduled to report their earnings on August 5th. So not too far from now, but the company making the decision, I guess, to put some good news out there in the market. They did rise today with a lot of the other sort of chip AI names. But I will note that prior to that, they had closed out 6 straight days of losses on the stock, which had been their longest streak since March 2025. But as discussed, I mean, you take a look at that after-hours rally, now higher by more than 11%.
And we should point out, sorry to interrupt,
please.
I mean, just in regards to that share performance, too, we talk about, go back to that last earnings report, what you did see about a pop in the shares, like a 25% rally that day. But by the time you got to the beginning of June, that began to sell off as a lot of those concerns set back in. Those shares heading into today were down, about 50%? Since the start of June?
Yeah, right. And down 13% year to date, but it doesn't reflect certainly the big pullback that we've seen. I should also point out 19% of the float is short, so there's certainly that negative sentiment continuing. All right, folks, but it is up. Supermicro right now up about 13% in the aftermarket. All right, we got to run. That is our cross-platform, radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. Katie and Romain back there on the close on TV. Tim and I right back here on Bloomberg Business Week Daily on Bloomberg Radio. Folks, we will see you again, same time, same place tomorrow.
And when we come back here on The Close, we are going to continue discussing AI and its impact on investing, where to hide as the build-out filters into equity and fixed income markets. Aaron Mulvihill is going to be joining us over at JP Morgan Asset Management when we come back after the break, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick. A decent rebound rally here in U.S. equity markets on the day, with the S&P up about 0.9%. The NASDAQ 100 up almost 2%, and the Philadelphia Semiconductor Index adding about 5%. In fact, that is the best day that we've seen for the Philadelphia Semiconductor Index in about a month. This despite some of the concerns brewing underneath the surface with regards to the resurgence in inflation, a fourth straight day of gains for the two-year Treasury yield, and that, of course, is on the back of multi-day gains for WTI and Brent crude. Brent crude up now, back above $90 a barrel.
Well, I want to go to the second line on your board here and talk a little bit about Micron, one of your biggest gainers when it comes to a percent basis and a points basis. Today, shares higher by about 12%. Intel also having a great day, higher by about 8.6%. We know they report earnings in a few days' time. Also reportedly planning layoffs as well, giving a boost to shares. And just wanted to highlight Figma, a big down day for Figma. Of course, you remember their IPO just about a year ago. It's been a rocky ride since then. Another rocky ride today, down about 8.7%. But let's get to our top story this hour, and that is the AI bond boom. Barclays lifting its 2026 U.S. corporate bond supply forecast on much larger than expected AI funding. Now, our next guest says it's getting harder to hide in a market dominated by AI, not just in equities, but also in bonds, where some 19% of the public market is now tied to AI-linked companies. And Romaine, that figure by consensus estimates is only expected to grow.
All right, well, let's get some insights out of Aaron Mulvihill, global alternative strategist at JP Morgan Asset Management. And of course, we understand why there's so much interest, of course, in the AI trade, whether it's in the equity space or in the bond space and beyond. Has that sort of been dispersed appropriately? I'm talking in terms of where people are buying into.
Yeah, there's a whole spectrum, and I think investors are getting a little bit frustrated maybe with the AI trade, where I liked how you were discussing with Carol earlier. It's up, you've got up days, you've got down days. Today was an up day, and it's just tremendous amount of volatility inherent in AI, and it's obviously a transformative investing theme, but we do think it's important to be allocated to areas that are maybe less directly impacted by AI, or maybe have high potential appreciation, but are not impacted by AI themselves.
Well, let's talk about what exactly that means. So if you do want exposure to AI with maybe a little bit less of that sort of uncertain risk here, is that just investing in what? The land, the infrastructure, the power? Is there some ways to sort of truly insulate yourself, or to
They
some
certainly
degree?
are. Yeah, I mean, it's a choice of how much you want to be exposed to AI, and we look at it as a spectrum. So you've got certainly in the large cap equity space, high allocations to AI. You've got areas in the private markets like venture capital, where 90% last year of issuance was into AI themes. But then as you go down that spectrum, look at areas like private infrastructure, where it's investing in the electricity, the power that's powering AI, but not in specifically AI data centers, where there's a bit more volatility. Then if you go further down that kind of trend, look at areas like commercial real estate, where there's not a lot of AI positives or negatives, but there's some opportunities for capital appreciation going forward.
Well, you mentioned data centers, and you mentioned the volatility there, and sort of the big existential question is whether or not we're overbuilding to an extent that, we haven't seen since you think about the fiber build out, the telecom build out. And I wonder, what you're hearing, what you're seeing when you think and talk about those risks of that overbuild.
The fiber one is a good historical analogy, Katie. We talk about this a lot, actually, because you had in the 90s, we built a ton of fiber. It's taken a very long time to have that fully lit, and now we're using it with internet and everything else. But it took 20 to 30 years. Will we see something like this in AI? That's an unknown, and it's one of the risks that is inherent in direct data center investing that's maybe underappreciated. Some other risks are not only the risk of overbuilding, but also the direct investment in where you've got a lot of winners and losers in AI. You need to be appropriately diversified. And it's very challenging to get that diversification today in public markets. A lot of the AI leaders today are not publicly listed. They're in venture capital firms, they're in private equity firms. So you have to have exposure across this trend as well.
And so some skepticism emerging when it comes to data centers. But when it comes to real estate overall, it's something we talk about a lot on this show, particularly commercial real estate. What are you seeing emerge when it comes to office? Because for so long in commercial real estate, it felt like it was ex-office. You saw that appended all the time. But it feels like that story has changed.
It has, and it's changing. It's been one of the beaten down sectors across the space, particularly the office space, since COVID. So you had the work from home trend, of course, was a big move. And then in 2022, interest rate hikes didn't help either. And we're starting to come out of this hole that office has been in for the last several years. We're seeing some very positive trends now in the office space, but it's not universal. It's more on, firstly, AI is helping office to some extent because AI linked or AI companies have added about 10% to total office leasing in the last quarter. So as the AI companies and startups, they actually prefer to have people in the office, so they're renting more office space. So it's helping, but also the broader commercial real estate market is recovering. And so now my favorite stat is office occupancy is 99% of where it was at pre-COVID levels. Midweek, not all week, but we're there on a Wednesday and we're getting there for the rest of the week.
Yeah, just don't come in on Monday or Friday. It'll be a ghost town in certain offices. With regards to the recovery that we've seen, I've actually been kind of surprised by the recovery we've seen in the office space, not just in major centers like New York, but really across the country. What about on the retail side, in terms of consumer retail? Because that seems to be much more of a mixed bag. I've seen some of the numbers, which seem to suggest there is, but then anecdotally, I mean, you walk around New York City, Chicago, any major city, you can see the vacant storefronts out there.
You do, and you see this is sort of the K-shaped economy manifesting where the coastal economies are doing very well, the luxury malls are doing very well. That was one of the highest performing asset classes across the retail space last year was regional malls. But again, that's not universal. So a lot of retail space we see as potential conversion to residential, where it's the non-luxury space, because the bottom kind of 10, 20% of consumers are struggling. The top consumers are continuing to spend. And so we're seeing a very different market trend play out between luxury and the kind of the high-end retail versus the lower-end retail.
Yeah, it's interesting. A lot of dispersion there when it comes to retail, similar to what we're seeing, of course, in these equity markets as well. We're going around the world with you, but I also do want to get an update on private credit because I know that's a story that you've been following as well. And when it comes to the retail investor, I mean, that's the nuance that has been made, that institutional sort of staying steady here, retail maybe bailing a little bit. Is that still the story?
We still see this trend playing out. I would stress that retail today is a relatively small part of the total private credit space. So you're talking 5 to 10%. Most institutional investors, they're in long-term locked-in vehicles. The first couple of quarters, we did see some exits in retail in the private credit space, but there were also a lot of inflows. We're continuing to see inflows even as some investors head for the exits.
With those inflows, though, is that going into, I mean, I know whenever you talk to some of these folks, particularly in private credit, they talk about, the halo type of companies, a lot of the middle market lending, which seems to have, if not avoided AI, certainly not gone headfirst into AI and software the way some others have.
Software is one of the sectors that investors still appear to be avoiding. We're seeing new issuance fairly sporadic in software, and it's at higher interest rates to compensate for that risk. Areas that we see as a very attractive right now would be asset-backed lending, where there's a collateral behind the lending, distressed lending, special situations lending that can actually perform better in a down market. The hardest hit part of private credit has been the direct lending space, that kind of plain vanilla lending to small and middle market companies. That's been the most competitive and the most challenged in the last several quarters.
All right, Aaron, great to get some time with you. Appreciate you stopping by the studio. That is Aaron Mulvihill. He is Global Alternative Strategist over at JP Morgan Asset Management. Now coming up, a mega moonshot and a biotech boom. We're going to track the trends driving this year's IPO market next. This is The Close. China's moonshot capturing more investor attention in pre-IPO talks with Excitement building around a potential $50 billion valuation for the AI lab. But data compiled by Bloomberg reveal a dark horse sector stealing some of AI's IPO thunder, biotech. Here to discuss the state of the IPO market is Bloomberg's Bailey Lipschultz. And let's start with what we're seeing when it comes to these biotech IPOs, since I know Romain is also enamored with this stat that you take a look at their weighted average return, 55%. I mean, IPOs for these AI companies, it seems pedestrian by comparison.
It does, Katie, but how quick the turns have tabled, or whatever the saying is. Because when you think about it, the biotech market has been hot and cold. So when you track back to 2020 and 2021, anyone who kind of had the idea for a drug could go public. IPO market kind of, the tide goes out, activity slows. You see pockets where it picks up. JP Morgan, obviously, start of the year typically is when we see biotech IPOs tap in the market. But we've been seeing more and more, and we've been seeing them, to your point, perform quite well. And again, that does come with the backdrop of the XBI up, 80% in the last 12 months? So the sector is back in vogue after we saw so much paper being raised for AI and AI adjacent companies really to start the year.
Well, I guess the question then, was this just sort of the pipeline was there already and that's why we sort of got this? And obviously, my assumption, and correct me if I'm wrong, is that I would assume a lot of these biotech companies are probably maybe a little bit younger than some of the bigger traditional tech companies that have come to market and thus maybe potentially offer a little bit more upside?
A little more upside, but Romain, biotech offerings typically are what we would call clubby because it's typically people who are already investing are going to allocate in the IPO. So we've seen the biotech IPO market kind of march to the beat of its own drum because of those dynamics, because it's seen as kind of separate from the typical market ebbs and flows. We also have seen, again, times where biotech starts to step into the spotlight when we see typical seasonal lulls. So January is normally slow for IPOs. Well, biotech tends to be pretty active outside of the JP Morgan conference. So you're looking at mid-July through mid-August, 6 biotechs being on file, taking the baton because most people are going on their vacations now that SpaceX has been public for a month.
Absolutely. Well, we're talking about biotech, how it's been sort of crushing when it comes to returns recently when it comes to AI. But we can't get too far away from AI IPOs. And we have to talk about Moonshot. I mean, it's really taken the markets by storm over the past week and now reportedly preparing to begin discussions about a listing in Hong Kong potentially next month.
Potentially next year, in the next 6 months. They'll be potentially raising a new round at $50 billion. So this would be seen as their last round. They're closing around at $30 billion or just north of that. Kind of U.S. style of scale. We're going from 31 to 50. The big question, though, is Moonshot looking to list in Hong Kong stands opposite DeepSeek, which wants to list in mainland China. Very different investors, very different markets. So it's going to be interesting to see how they kind of race along each other as we track OpenAI and Anthropic.
Well, as we track OpenAI and Anthropic, is the idea that, it seems like Anthropic is almost ready to go. Is that something that we're going to start to see, before the summer's out, or we're going to wait till the fall? And then what's going on with OpenAI? I feel like every day I see a new story, a new report here about changes they're making to try to get this IPO in shape, but it doesn't sound like they're as close.
Yeah, starting with OpenAI does not sound that close. Reports that they added 2 new members to their board. They're still figuring out Fidji Simo leaving the company for health reasons. She was a hire that was going to come in and kind of clean up operations. So big question mark for OpenAI there. According to our reporting, Anthropic right now is meeting with some of the largest long-only funds this week in the first round of so-called testing the waters meetings. This kind of lays out the expectations for what is the pitch going to be to investors who are not familiar with Anthropic, and what does the valuation and raise look like. That, again, would kind of set the table for, call it September, October.
Investors who aren't familiar with Anthropic, there's still some of them out there?
What do their earnings look like? We don't know.
That's true.
Existings know, but it's not public yet.
Fair enough.
And that news on OpenAI a little bit earlier. Robin Vince, of course, the CEO over at BNY, and David Velez, the CEO of Nubank, being added to OpenAI's board. When we come back, we're going to talk a little bit more about what's going on in the markets, particularly from a trader's perspective, and the rise, and more importantly, the concentration and importance of retail investors to this broader market. We're going to talk to Tom Sofnoff, one of the godfathers of derivatives trading. An eye on the markets and an eye on retail trading activity, which is reaching new levels here in the U.S. New data out from Goldman Sachs showing retail investors now account for roughly 30% of daily U.S. equity volume. And that research also shows this isn't temporary, it's structural, and it's here to stay. Joining us right now to talk about the changing dynamics of the U.S. equity markets is Tom Sosnoff, the founder and co-CEO of Lost Dog, of course, one of the godfathers of options investing for the retail set. Great to have you here, Tom.
Great to be back.
Let's talk about sort of the rise of retail investors, because it's gone beyond just buying and selling stocks, but obviously buying and selling options as well. And I think that has sort of created a lot more concentration and, more importantly, a lot more sway, at least in aggregate, for retail investors relative to the institutional set.
No question about it.
Yeah.
I mean, back when we were market makers, the CBOE accounted for was the largest customer of the New York Stock Exchange. And now I think what's happened, you just said 30% of the equity volume, but the derivatives volume is probably closer to 60 or 70%. It's just wild. So, and a lot of that grows the equity volume as well.
I know you're a fan of that, but of course you also know the critics say, okay, this is just gambling with Greek letters when it comes to letting retail traders go in on that, and now with zero-day options as well. Is there what's happening here? I know it's easy to dismiss this as just gambling or just speculation, but if you talk to retail investors, at least the more serious ones, they, in a lot of ways, are using this in the same way institutional investors would, whether it's with regards to hedging or having more strategic shorts and things like that. Give me a sense of just the complexion of what we see in the options market with how retail traders are using it.
Well, I would argue that strategic finance and strategic investing among retail traders has grown exponentially. And the crazy part about it is it's all about capital efficiency. It's not just about speculation. And I think the comparison to gambling is really tough. It's okay to compare to gambling if you're talking about prediction markets. It's okay to compare to gambling if you're talking about things that aren't efficient. But you trade, for example, $100,000 worth of Apple or $100,000 worth of, any $200, $300, $400 stock. You're talking about $4 in theoretical give up from bid to ask. That's nothing like gambling, where it's $4,000 on $100,000 in bets, or prediction markets where it's $2,500 on $100,000 in bets. So I disagree with that, statement. And it's just broad-based. I think retail investing on a strategic level for active traders, for passive investors, whatever it is something that's not only here to stay, but it's going to continue to grow.
Now you really have power tools, though, when it comes to the retail investors and some of the vehicles that are on offer. I cover ETFs very closely, and what we're seeing when it comes to leveraged single stock ETFs, what an interesting case study you have in South Korea's markets, where you have this sort of tail wagging the dog effect. And there are some worries that you could see that dynamic come to U.S. markets if it doesn't already exist. And I wonder, how you think through some of these new access points that have really just arisen in the past couple of years.
Yeah, so it's really interesting because the product growth is fascinating, and I think there is room for some expansion product-wise. But I think the real change is now going to come with just the incredibly fast growth of AI and agentic agents, which is essentially going to give every retail investor, because every platform is going to support multiple integrations with agentic agents. And I think what's going to happen is, agentic agents is just like having kind of your own employee and your own really smart employee. And I think what's going to happen is that's going to level the playing field even more. So I think the most interesting change for retail investors now is not really all the new products, like not really perps or not really, single stock futures or any of that kind of stuff. I love futures, I love futures options, but I think the real change is going to be all the agentic tools that are coming out to support and complement, not to find trades, not to help you make a ridiculous amount of money, but just to support you to level the playing field.
And I do want to get your perspective on literal gambling. You said we can use that term if we're talking about prediction markets.
For sure.
That's where I want to go, because prediction markets have really taken off in a big way. And there is this thought exercise out there as to whether or not that's going to sort of take mind share, take volume away from the actual traditional equity markets when it comes to this retail trading cohort. And I wonder if you put any water in that sort of theory.
Well, you have to put you have to give it you have to give it some weight, but there's a big but. Prediction markets are what I would call they're very one-dimensional when it comes to money. So there's no leverage, right? So essentially, in our world, we consider that kind of almost dead money because there's no leverage and it's not strategic and they have ridiculously high fees. So although it's a really cool complement, I mean, to call it a prediction market sometimes is a bit of a stretch because sometimes it's just sports gambling or whatever. But at this point, unless it goes exchange-based, where there's a contraction in fees by dramatically, by like 80%, and there's a lot more high-frequency players in there to make better markets, I see it as kind of being a little bit of an outlier for a while.
Well, you use the word dead money. I mean, talk about tokenization of securities, which I've also heard you refer to as dead money, though you did see a little bit more potential for tokenization when it comes to derivatives. Is that correct?
Exactly. That's exactly my kind of talk on tokenization. I see equity tokenization as a little bit dead money. It's going to go in, it's going to sit there like crypto. I see the derivatives market being tokenized, potentially being explosive because it's capital efficient.
Explain that a little bit more, though. I mean, does that include the leverage that you would normally get in derivatives? Or
it includes the strategic side. So I'll give you an example. So you take a stock like Micron. Let's say there was an Indian version of Micron or a Chinese version of Micron, whatever. It doesn't matter where in the world it is that you tokenize it.
Gotcha.
And you have a $1,000 stock. That's very difficult for people to afford to trade. But if you spread it off in the derivatives market and you do, let's say, a $5 wide call vertical spread, you can trade it for $100.
Yeah.
That's the difference.
I just want to ask, just to stay on this topic, because I mean, you know so much about options. And one thing I was looking at when we were talking about the rise of retail trading, we were looking at options, open interest, and the volume. A lot of it is still weighted towards calls, to people buying calls.
Well, we're in a bull market.
I understand that, but you've also talked a lot about this idea of selling puts as a way to make them a little bit more money, or at least a little bit risk-adjusted return there. Why don't we see a little bit more people employing that strategy, even in tandem with buying calls or whatever else they might be doing?
This market has been hyperbolic in certain areas, especially among chip stocks and things like that, for quite a long time now. So the asymmetric opportunity, like the crazy upside, has all been to the upside of the market. Like if you want to turn $10 into $100, it's been on stocks like SanDisk and Micron and AMD and things like that. So you see this ridiculous call skew, which is a byproduct or a function of a market that just is in that hyperbolic mode. If this market if we were in a bear market, you would see the same kind of premium on the put side.
Gotcha.
And I mean, Tom, we could keep going, but while we have you here, I do want to talk a little bit about Lost Dog as well, because I know you came on the program earlier to talk about it. I was off that week. I wasn't here.
How could you?
I am fascinated by this. So you describe it as a wealth and career AI optimizer. Basically, it tells you what you should be paid today, what your portfolio should be worth in the future. Where did this idea come from, first of all, and who should be using this? Is this for someone just sort of entering the workforce, or does this work later in life as well?
Oh, it works anywhere for people that have, for portfolio size, it would probably be a little bit later because most young kids don't have portfolios. But for salaries, it's anywhere between $60,000 a year to, let's say, $350,000. Over $300,000 and $350,000 gets a little more subjective. But the genesis behind Lost Dog was really we built a bunch of trading platforms our whole career, and we got to the point where we said, you know what, this wealth gap and wealth creation, like nobody's addressing it. So we wanted to just go after this, what we considered to be crazy inequity in the wealth gap. And that was kind of the genesis behind it. It's now expanded into like a whole digital ecosystem and a lot of agentic tools, but that's where we're at.
Well, it's super cool, Tom. Really appreciate you stopping by. Really enjoyed this conversation. That is Tom Sosnoff. He is the founder and co-CEO of Lost Dog. Meanwhile, let's take a quick look at some of the big movers after hours, because there's a few of them. Take a look at what's going on with Supermicro. We broke the news with our radio friends that they're coming out with updates on their margins and backlog forecasts. You can see shares popping by about 15 to 16%. We're also taking a look at HPE, higher by about 5% as well. Alaska Air falling about 3% after hours. Oklo up about 4%. This is The Close on Bloomberg.
All right, time to talk real estate. And I want you to forget penthouses for a second, because today's wealthiest investor is increasingly turning to Landmaxxing. at least according to real estate firm Coldwell Banker. A new report from the company showing affluent buyers purchasing larger properties and neighboring homes to optimize their privacy, their views, and, well, their legacy, too. Mary Lee Blaylock is the president of Coldwell Banker Affiliates, and she joins us here in Studio 2. Mary Lee, great to see you.
Nice to see you as well.
Well, let's talk about this. I mean, on one hand, I guess it makes sense. I mean, I feel like rich people have been doing this for a while, but this seems to be a growing trend. This isn't just sort of the ultra rich just buying up acres and acres around them.
Right.
This is even people on a slightly smaller scale saying, look, I want to have my property, protect my views, or have a little bit more privacy. How widespread?
It is becoming more widespread. I would say this is a really fun and interesting trend that was precipitated by the searches online. So the searches online now have gone to views and land and how can I expand in what I'm looking for. And if you have cash and you are affluent in that market, you're able to expand that more quickly. So as an example, when all of the transfer of wealth has been occurring or is starting to occur from the baby boomers down into the Gen X and the millennials, what's next is the opportunity for those people to invest it in real estate. And it's a safe haven, as it always has been, but even more so now. And with the multi-generational opportunities for families to live together in kind of a compound, if you will, opportunity, I think that allows them to use this landmaxing in their optimal way.
Geographically, where are we seeing this trend most?
Yeah, I mean, almost everywhere, but think about where there's land.
Yeah, not here in Manhattan.
Right, there's not a lot of land in Manhattan, nor is there a lot of land in many different places.
Yeah.
So if you're not able to find the land and the views, they're then looking at how do I buy up the neighbors? And how do I create it myself, if that is also occurring. So it's certainly in Florida, it's certainly in parts of California, it's in other, Utah, Aspen, Colorado, those types of areas where the land is premium and the views are phenomenal. And we will see where it goes.
How much of it is actual land, like pure land maxing? I just want to amass as many acres as I can.
So it's early in the game.
Yeah.
And we are watching the trends very carefully. And we'll certainly bring it back to you when we have more data to support it. But right now we're seeing the interest level from a perspective of searching, from a perspective of this transfer of wealth, spending it on real estate as a great asset, and planning for maybe some aging parents, and being able to take care of them in a different and more profound way in close proximity.
And so you mentioned, this is something that you're seeing if you have cash. And I want to talk about the cash portion of this, because I have to imagine that, particularly when it comes to land maxing, but luxury real estate in general right now, a lot of these are all cash transactions.
Absolutely, they are. That has been the trend for a number of years in the luxury space, but even more so and in more profound price points. So it was, $1 million, $2 million, $3 million. Now it's cash in anywhere, in any price range. And it's because they're finding it as a great investment and an opportunity to place their cash in a safe place while the markets might be volatile.
From an investment perspective, and this goes beyond land maxing, as you sort of look at the real estate market, are we seeing more participation by foreign buyers? I know it seemed like a few years ago, certainly here in New York, those buyers sort of got scared by a lot of issues going on here in the U.S. Have they come back?
They have come back, especially on the coast. If we look at New York and California in particular, there's a lot more interest and a lot more searches going on in those particular markets from the global perspective, and in California in particular. So we will see how that plays out from an actual purchase perspective. But right now, what I like is that their interest is there and that we're able to facilitate that.
Well, when we talk about facilitating that, is the inventory there for these folks?
Yeah, the inventory hasn't grown greatly, honestly, and in certain markets, certainly, it still flies off the shelf in a certain price points. But there is an opportunity for it to grow slightly and continue on that path as we extend through the end of the year. Sometimes that's in relation to, however, that buyers are pulling back and waiting for rates to drop. So there's a false read on an increase in inventory until the buyers come back into the market.
Yeah, I was wondering about that dynamic because, I'm taking a look at some of the stats you provided for us when it comes to the luxury housing market for both single-family homes and for attached homes. You do have those inventories falling. You also have the median monthly sold price rising a bit here when it comes to single-family, but for attached homes, it's actually down a little bit. And I do wonder, if we do see rates drop, how many people are just waiting on the sidelines to come and then drive those prices higher?
Yeah, well, it will be fun to watch, and it will be fun to partake in, of course. But in addition to that,
except for those buying the homes,
right? There might be a bit more competition. You'll have to live with that, but we'll guide you through it, no problem. However, I think there's also a piece of the inventory that is kind of waiting in the wings as well, to ensure the fact that there's a false read of some shadow inventory occurring. So they'll come to the market. Hopefully, the buyers will come to the market. Rates will drop, and it will be nirvana for us.
With regards to that shadow inventory, too, I know there's been some regulatory changes that maybe sort of provide a little bit more insights for the potential for the real estate agents, I should say, in being able to sort of get some of these properties to those folks who want them before everyone else gets a nab at it. Is that becoming a little bit more of a lever that you can use?
You know, it has been there for quite a number of years, honestly. It's gotten a bit more press, and it's a bit more of a norm in practice, which I think is actually a healthy thing. It allows sellers to kind of test the market, see what's going on with the market before they full-fledged put the home on the market. But in addition to that, allows buyers to kind of preliminarily shop, see what price points are out there, what works for them and what doesn't.
All right, Marilee, so enjoyed this conversation. Landmaxxing. Really,
I know.
Landmaxxing.
I love it.
Yeah. I'm not sure I can do that on my neighborhood, but you know,
yeah, that's
but Godspeed to those.
Might be hard. Might have to get off the island of Manhattan. That is Marilee Blaylock. She is president of Coldwell Banker Affiliates.
All right, still ahead, we are counting down to those Mag 7 earnings, including from Tesla. We're going to break that down when we come back after the break, right here on Bloomberg.
Mag 7 earnings set to kick off tomorrow with Alphabet and Tesla taking center stage. Now, when it comes to the EV makers, investors closely watching for more information on the company's spending plans and updates on its robotics efforts. Stephanie Valdez-Streety, she is a director of industry insights over at Cox Automotive. She joins us now. Stephanie, great to have you with us. We know we got those second quarter delivery numbers. We know that they looked pretty good relative to expectations. We know it's not the full story, though. What will you be looking out for when we get those numbers tomorrow?
Yeah, thanks, Katie. I think, Tesla definitely beat the production and delivery Q2, and they were able to kind of dive down that 50,000 units that they overproduced in Q1. But I think looking at Q2 and tomorrow, it's really what that margin is. They sold a lot more vehicles, they were up 25% year over year. But how did they get there? What was the profit? Did they have to use pricing declines, incentives? And that's really going to tell the story of how they ended up from a revenue grew, but what was the profit from that quarter?
And we know that, when it comes to Tesla, it's not just about the EV business for them. They have a lot of hopes and dreams when it comes to robotaxis, when it comes, of course, to their humanoid robots and everything else. When it comes to sort of their capital spending plans, what do you make of how they're sort of threading the needle between, the core car business and what potentially they're staking their future on?
Yeah, I think it's a very tricky navigation. If you think about the 6.7 capital, the CapEx, trying to scale AI, robotics, manufacturing, I think that's the other thing for tomorrow's call, to see how are they progressing on that. What's the timeline? What's the measurable progress? Because with Tesla, we know what the vision is, but it's the execution and how we're going to get there, and how is that capital allocation? How is it turning out, and what can we expect in the upcoming year from all that investment?
Well, I'm curious, as investors try to value this, I know there's been a lot of talk about the energy storage part of this business, but it's still something like 10, 11, 12% of revenue compared to the rest of the business basically being directly in the car side of it. Is the energy business a growth business, or is it just sort of a supplementary add-on?
No, I think it's definitely an area for Tesla that's a shining light. It's a growth business. If you think of, we hear in the news every day, AI, data centers, the growth. I think that's one thing that they're going to, ride that wave of the growth in data centers. But also you think about utility scale deployment with battery storage. They're well positioned for that. And it's high margin. So I think that's an area for Tesla that I think is going to be something positive that we'll hear about during the call tomorrow.
But is that a part of the business that they can be genuinely competitive? And I bring that up because I felt like a few years ago, they were one of the few games in town on that. Now, everybody's trying to find a side hustle in the energy space, even not just the other automakers, but a lot of just industrial manufacturers as well. Even when it comes to automation and some of the other aspects of this business, a lot of other folks are either doing doing it, or at least trying to do it at a way at some degree of scale? How competitive is the space?
No, it's very competitive. You're right. And I think, and if you think about, because especially, passenger EV volume going down, a lot of these battery companies have pivoted towards stationary storage, battery energy storage systems. So there's definitely a lot more competition. So I think in the upcoming 6 months, year, we'll be able to see how Tesla fares with that new competition. It's fairly similar to the EV passenger. Tesla was they still dominate, but now they have a lot of competition, and that's continuing to eat into their share and profit.
All right, Stephanie Valdez-Streety, Director of Industry Insights over at Cox Automotive. And if you're taking a look at those numbers here, investors expecting about $26 billion in revenue for the most recent quarter, 50 cents on the EPS side. As we set you up for what to watch over the next 24 hours, Katie, the market is going to have their eyes on earnings, but first, before the bell, with a couple of non-Tesla companies.
Absolutely. We get an update from AT&T, also from GE Vernova. That is before the market opens. After market, it's certainly going to be popping, Romaine.
Yeah, we mentioned Tesla, but I have a feeling that really what's going to really steal the show after the bell, we get Alphabet, Texas Instruments, ServiceNow, and IBM. Of course, IBM been in the news lately for some of the wrong reasons.
Yeah, absolutely. Yeah. Some shockwaves going through their shares when they sort of pre-announced some results last week.
And all these three companies, Alphabet, Tesla, IBM, maybe ServiceNow, Texas Instruments, all five, really going to give us another read here on the AI trade overall and where everyone stands in it.
Certainly, definitely going to be a sign of the times moment. We also get at 7:30 a.m. MBA mortgage applications, and 9:15 a.m. I'm pretty excited. Wells Fargo CEO Charlie Scharf, Romaine Bostick, right here on Bloomberg.
Yeah, exclusive sit down with the CEO of Wells Fargo. Definitely want to check that out, Katie Greif. I hope you're in early for that.
I'll be here.
Yeah, and on the tech side, I don't know if you care, Katie, but Samsung, a foldable phone, buy 3.
The future is now.
This is Bloomberg.